Welcome to the August edition of Centrum Wealth Monthly Outlook. Interestingly, there has been no new significant negative development in the month of August. The same three themes continue to dominate majority of the investor conversations, which is AI, geopolitics, and monsoon, so far as Indian markets are concerned. Let's deep dive into each of them. On the AI front, the Korean markets in the month of July corrected in excess of 40%. According to me, it will be foolish for us to start questioning the AI theme at large. The more interesting question would be how sustainable are the earnings from the entire AI capex being done by the globe and the hyperscalers. CXMT, a Chinese chipmaker company, debuted in the month of July and has been the major reason for worry in the circle of Korean chipmakers. On the other hand, even the US hyperscalers like Alphabet have now seen a negative free cash flow quarter in quarter two ever since their listing way back in the early 2000s. Same is the case with Meta, where the free cash flow in quarter two dipped below $1 billion, more than 90% below their average. Microsoft, on the other hand, has delayed their AI capex investment program over the next couple of years. The money which is now getting freed from these AI capex investments is looking for a new investment haven, and India turns out to be a very good candidate. This is the precise reason why the FII flows in India for the month of July turned out to be in green, amounting to approximately $2.3 billion of inflows against the backdrop of over $57 billion of outflows since October 2024. Hence, on the flow front, we can expect the DIA flows to continue to remain strong thanks to the strong SIP inflows month over month, and the FII flows to be at least not in the stark reds as we have seen in the past. On the valuation front, India continues to trade below its 7-year average. In fact, indices in Nasdaq and KOSPI are also trading below their 7-year averages. However, in the case of these markets, the undervaluation is more because of the hyper earnings growth expected from the AI-led companies rather than the broad market-based undervaluations. On the return fronts, the 3-year rolling return of India is now 7% versus 3-year rolling 10-year average of India being around 13%. Hence, India again stands out to be a very good candidate for mean reversion. All in all, we expect Indian equities to be very constructive in the forthcoming 2 to 3 years horizon. The Nifty is expected to grow this year in the handle of 12 to 14%. For the quarter one earnings, where I guess 39 of the 50 companies have announced their earning results, the revenue has grown by 19% versus the expectation of 16, and PAT has grown by 11% versus the expectation of 7. Hence, right from sentiments to flows to valuations, all the indicators are in green. We would request all our investors to have a very constructive outlook towards the Indian equity markets. It's a buy on dip market. Every time you see a new low getting made, it's an opportunity to invest more money into the markets. Look at large caps because the valuation gap between the mid caps and the large caps have widened. However, the tilt should be towards a flexi cap manager who at some right point in time will be able to switch their positions from large caps into mid and small caps and help the money get the benefit of the accelerated growth that can be expected from the mid and the smalls. Coming on the debt side, Fed FOMC concluded only recently. While Fed has maintained the rates, but there were 3 dissenting votes for a rate increase. Consequently, we have seen a bear steepening in the US yield curve with 30-year now rising in excess of 5%. On the other hand, India MPC is expected to take place very soon, and the markets are expecting RBI to leave the rates unchanged. In India, we are actually witnessing a bear flattening on the yield curves, where the near end is playing rising much faster than the far end. Consequently, the 30-year yield gap between India and US has now merged to as slim as 220 basis points approximately versus the historical average of 400 to 450 basis points. A clear indicator that the INR depreciation over the coming years will slow down from the average of 4% plus to handle of 2.5%. On the yield side, we believe that the Indian corporates are still offering rich yields to the investors in the 2 to 3 year curve, and one should take benefit of these double digit yields which are available. Duration at this point in time, according to us, can be avoided for the normal Indian investor. So far as gold and silver is concerned, we continue to remain very constructive in our outlooks. We need to understand the nature of the beast. Both gold and silver can continue to remain in a slumber mode for a relatively long period of 2 to 3 years before their next move. However, 6,000 on gold and 8,200 on silver is not ruled out in the coming 2 to 3 years. Hence, overall, we remain constructive on Indian equities. On duration, we recommend our investors to book profit. On yield, we continue to recommend investments in performing credits and structured credits so far as the Indian space is concerned. And lastly, we continue to remain constructive on gold and silver. Thanks a lot.